Welcome to the Deep Dive. Today we're cutting through the complexity of India Energy's latest financials. We're looking at their 9-month 2025 report, and we're doing it specifically for you, the individual investor.
And this is a really crucial one. We're looking at numbers adjusted for hyperinflation under TMS 29. So these aren't just nominal figures. This is about the real purchasing power of the company. And the main story here really is a huge infusion of cash and what that's done to the company.
Exactly. We're here to give you actionable insights, so if you find this kind of analysis valuable, please do hit that like button, subscribe, and of course share it with anyone else who wants to be a smarter investor.
Okay, so let's set the stage. Who exactly is India Energy?
Well, they've been around a while, established back in 1993, based out of Izmir. They are, a classic diversified renewable energy company.
So they're not just a one-trick pony.
Not at all. They've got hydroelectric, that's HES, wind, RES, geothermal, JES, and even solar GES. It's all domestic right here in Turkey, and they handle everything from production to trade through their subsidiaries. That diversity is key, right? If the rivers are low, maybe the wind is blowing. But historically, the big stabilizer for these companies has been YEKDEM, the incentive mechanism with its USD-based pricing. Where do they stand with that?
That is the million-dollar question for their operations. YEKDEM is certainty. It's gold. The challenge for them is that their older plants are, well, they're timing out.
Okay, so which ones are we talking about?
Axe Hydroelectric, that lost its coverage back in 2020. Tesla Geothermal in 21, and Agenda Hydro in 2023. So those assets are now fully exposed to the spot market.
Wow. So some of their core hydro and geothermal assets are now fighting it out in the open market. That sounds like a pretty big risk.
It is, but it's a calculated one. It's mitigated because they're really critical wind and solar assets. They're still covered. Yeah, their main wind farms have coverage until 2027. And their newer solar projects get a full 10 years of YEKDEM support. So as the old assets become merchant, the newer ones are still providing that guaranteed revenue. It stabilizes the whole picture.
Got it. And before we jump into the numbers, what about the corporate structure? The IPO must have shaken things up.
It did. The big shareholders now are Margan Energy with about 24% and FIBA with just over 8%. The public float is almost 21%. And they've also staffed up a little, went from 91 people to 96.
And what about the folks at the top? Management compensation.
That's up a bit. Total fees and benefits went from about 13.9 million Turkish lira to 17.4 million. Yeah. It's more or less in line with inflation and the added complexity post-IPO.
All right, let's talk about the big one, the IPO. February 2025, they raised 1.76 billion lira. That number hangs over this whole report. But first, how did the actual operations look? The top line.
The top line is, well, it's a bit jarring at first. Revenue, or zero, dropped a lot, down 22.4%, from over 1.2 billion TL to just 942 million.
Ouch. And I'm guessing gross profit followed suit.
It fell off a cliff. It collapsed from 168 million TL to just over 70 million.
Okay, a 22% revenue drop is one thing, but gross profit getting cut by more than half. That suggests their costs are pretty sticky. Is this just bad, weatherless wind and rain, or is that loss of YEKDEM already biting into their margins?
It's a bit of both, I think. The report points to lower production volume as the main driver, especially from wind. But you're right about the costs. Their cost of sales stayed high, almost 872 million TL. When revenue falls and costs don't, well, margins get crushed. Simple as that.
But this is where the story gets weird. I was looking at this. Their core operating profit, it actually went up slightly from 119 million to 129 million. How on earth does that happen when gross profit collapsed?
This is where you have to dig into the footnotes. It's a fantastic catch. The entire gap was plugged by a massive one-time item called other operating income.
Other operating income.
Yeah, they booked 175.5 million TL there. Last year, that line item was actually a small loss.
Wait. So they went from losing a couple million on that line to gaining 175 million. As an investor, I have to ask, what is that? Is it an asset sale? A government grant? What's going on?
And that's the problem. The report doesn't spell it out, so it creates this gap in understanding. It means their core business of just making and selling electricity was much, much weaker. The overall picture was saved by this non-core, maybe non-recurring item.
So the EBITDA number, the 493 million TL, it looks stable, but it's standing on a shaky foundation.
Exactly. The cash generation capacity is there, but the source of that cash in this period is a bit of a mystery.
Okay, let's pivot to the most transformative part of this report, the debt story, which is really a cash story.
This is the huge positive. The IPO allowed them to just deleverage in a massive way. Total financial debt fell from over 715 million TL to 515 million. Bank debt alone dropped by more than 160 million.
That's a big drop, but the change in the net debt number, I mean, that's just staggering.
It's a total flip. I mean, they went from being 243 million TL in net debt at the end of 2024 to sitting on a net cash position of 1.23 billion lira.
A billion with a B.
Yes, a game changer. They went from servicing debt to, well, having a massive war chest. It completely changes their risk profile.
So, with all that cash, what does the remaining debt even look like? Is it risky that it's all short-term now?
It introduces a little refinancing risk, but I mean, when you have that much cash, it's not a huge worry. The 289 million in bank loans is all due within a year and has variable rates. But remember, they also have that long-term debt to the state for the ACSE project, which is structured with payments out to 2030. So that's manageable.
Okay, another confusing point for me. If EBITDA was stable, why was their actual operating cash flow so weak? It was tiny.
Right, this is where accounting meets reality. Operating cash flow fell to just 27 million TL. Last year it was 226 million.
A huge disconnect from EBITDA.
A huge one. It's often down to working capital changes, timing of payments. But in a hyperinflationary environment, it's also those big non-cash adjustments from TMS 29. They can wreak havoc on the operating cash flow line, even when the underlying business is theoretically sound.
But the financing cash flow obviously saved the day.
Oh, absolutely. A net inflow of 1.58 billion TL. Almost all of that, 1.4 billion, was the IPO cash. And that's why their cash on hand nearly quadrupled to 1.75 billion TL.
So they've got the cash. Now what? What's the plan? Where's this money going?
They're putting it to work. We saw them spend about 271 million on fixed assets.
Yeah.
But the really interesting number is under ongoing investments. There's 290 million TL in there. That's your future growth. That's the cash being turned into new plants that will generate revenue after the old UKIDM protections are gone.
Okay, before we wrap this up, let's touch on two big background risks, the hyperinflation accounting and the currency exposure.
Right, so TMS 29, you can't avoid it. The numbers we're talking about are all standardized to the lira's value on September 30th, 2025. This is meant to give a true picture, but it creates these massive non-cash gains or losses that can be really confusing. It's why their consolidated net result is still a loss of 172 million TL. It's mostly accounting noise, not an operational failure.
And the currency risk, they have USD loans.
They do, but they have a classic natural hedge. They use their expected USD-based YIKDEM revenues to offset the USD-based loans. The sensitivity analysis shows it works really well. Even a huge 20% swing in the dollar would only impact their equity by about 20 million TL. It's very well managed.
And one final risk, valuing the actual power plants themselves.
That's a big one. Their value on the books is incredibly sensitive to long-term forecasts. The notes say a simple 10% change in future power prices could swing the value of their assets by 1.5 billion lira.
Wow.
Yeah. It just highlights how much their balance sheet strength depends on a positive outlook for the Turkish power market.
So let's bring it all home. What's the bottom line for an individual investor looking at EDA today?
The key takeaway is transformation. The IPO turned them into a company with extraordinary liquidity. They've shed their financial risk, and their core engine, EBITDA, is solid. The balance sheet is stronger than it's ever been.
So looking forward, the challenge isn't about survival anymore. It's about execution. They're sitting on a 1.2 billion lira cash pile. They have almost 300 million in projects underway. The question for 2026 isn't, can they pay their bills? It's how well can they deploy that cash to build the next generation of revenue?
And that's the ultimate question, isn't it? Can management turn that 1.2 billion into profitable assets quickly without overpaying? That's what will decide if the stock becomes a real growth story or just a slow-moving bank account.
And that is the essential thought for you to explore as you connect the dots. Thanks for diving deep with us. We'll see you next time.